Over $90 billion is invested in SCHD. For years, dividend investors have treated it like the gold standard. But what if I told you that over the last decade, SCHD wasn't the best performing dividend ETF? And what if I told you another ETF quietly beat it while almost nobody was paying attention? Today I'm putting 10 of the most popular ETFs head to head in a 10-year battle. We're going to compare SCHD, DGRO, VIG, VYM, HDV, JEPI, JEPQ, VOO, VTI, and QQQ. By the end of this video, you'll know which ETF generated the most wealth, which ETF produced the most income, which dividend ETF quietly beat SCHD, why one of the highest yield funds finished near the bottom, and the one ETF that absolutely dominated them all. Let's run the numbers, so stay tuned. Welcome back to Simply Money. Today we're doing one of the biggest ETF comparisons I've ever done on this channel. Using my Simply Money portfolio planner, I tested 10 of the most popular ETFs over the last decade. But this isn't just another ranking video, because each of these ETFs is trying to solve a different problem. Some focus on dividend growth, some focus on income, and some focus on broad market exposure. And one is built almost entirely for growth. The question isn't just which ETF won. The question is whether the winner is actually the right choice for your portfolio. Let's start with the dividend growth battle. I want to set a couple things up here before we open up the sheet. I'm going to run several different scenarios. The first scenario we're going to compare is looking at these funds compared to each other using the historical data. Now, this isn't a fair battle because you have some funds that have been around for 15, 20 years, and they have a lot of data to pull. And then you have other funds who have only been around for 2 or 3 years. So the older funds obviously are going to have higher total returns, and we're using the average annualized return over that period. It's also unfair for the older funds because they've been through different cycles, so their annual averages are a little bit lower, where something that maybe is newer and is in a bull run hasn't actually had that downturn, so the averages are actually higher than they would be over a longer term. So to mitigate that, we're going to do this first historical test. Then we're going to do 2 different forecasts using, first of all, the categorical funds. We'll put them in different categories, like the dividend growth versus the income versus just the pure growth and the broad market. So we'll see what those categories look like. And then the third one we'll do is we have the forecaster that looks at individual funds based on historical data, the market cycles, and what it looks like it should do in the future. Obviously, we don't know what the future holds, so all of these are speculative because even the historical, even though that's actual data, we don't know if that will continue in the future, whether there's 2 years or 20 years of data. We're just using it as the stepping stone to begin this. Now, let me start by saying this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know all investments come with risk. Now, those of you that have watched the channel may be surprised by this because I love SCHD, but there's been a surprise. There's a fund that I'm running here that has beat SCHD over these time frames. And I want you to stay tuned to the end, though, because there is a surprise. Even after we see the winner, there's a surprise in all this that might actually catch you off guard and you might not be realizing by watching just the beginning. So please stay tuned for that. Section 1, we're going to look at this, the dividend growth battle. We're going to pull up the sheet here. This is the Simply Money Portfolio Planner. If you've not seen this before or you'd like a copy of this, we do make it available down at the description below at Buy Me a Coffee. There's a link there. This is a great opportunity for those that want to kind of forecast and run different scenarios. What you can do is you can put up to 10 tickers here, and you can just click on here. There's hundreds of them in here to choose from, and you can put the tickers you want. It shows you what the yield and appreciation is based on the return mode. Right now I have it set at historical. That's based on since inception for each individual fund. So newer funds, it's annualized for whatever years it has. Older funds obviously have more years to annualize. You can also switch to these percentile modes, 10th, 50th, and 90th, Those are taking it by category. All funds that are dividend growth have the same return forecasted. Those that are in the growth category have the same return forecasted. This is more just a categorical, like if I'm mixing and matching different types of funds, what would that look like? And that's usually what you'd see in a Monte Carlo simulation. Now, these three, the manual 10th, 50th, and 90th, what that is doing, it's taking the forecast based on the individual fund, because just because something's in a growth category doesn't mean they're all equal. And so it takes different factors, it's historical data, it's sector, and different things that are part of that, and it forecasts it. And again, it is a forecast, so we don't know. But we're going to look at historical. You can see if we change that, it updates these. So you can see these dividend growth funds all have the same yield and appreciation. But if you go down to the manual, you can see that they differ based on different inputs that were calculated there. But we're going to start with the historical. This is based on what it has done. Over here, you put the portfolio beginning balance. So we're putting $100,000 in there, and we're splitting it 10% to each fund. That's $10,000, and we'll look based on the historical data how that performed one against the other. So that's going to be our first test. But we're going to go kind of in different categories, and we're starting out with the dividend growth battle. We're going to be looking at SCHD, DGRO, and BIG. I want to start with those. As we come over here, you can see that there's deposit rules and withdrawal rules. If you've not seen this before, we're not using it on this scenario, but I like showing this for people who might be interested. You can put deposits, and then you can put how much you want to go into each of the funds that you're calculating. So maybe I want to add $500 a month, and I want 50% to go to SCHD and 50% to go to DGRO. So I could do that, and you can say when you want it to start, when you want it to end. If you want it to have inflation added, you can calculate that. You can put up to 10 different rules with different starting dates and ending dates. You can do the same with withdrawals. You can have a fixed amount coming out. You can have a percentage of the portfolio. So if you're calculating what would my retirement look like in this portfolio if I take out 4%? Or if I need a certain income, what if I take out $3,000 a month? What would my portfolio look like down the road? And when would that start? So you can set all sorts of different deposits and withdrawals. We don't have anything set up on that right now because we're not doing that on this scenario. We're just looking with a $10,000 initial investment, which one of these funds with its average annual return over the last 10 years would have won. Now, if you want to run a pure back test, we have the drip sheets that are available. You can go in and get those, and each one you can put a starting date. So you could put each starting date, whatever you pick. So if you want to compare for 5 years, and you can compare each one and see how it is done, whether you're dripping or not dripping, and see which one has outperformed the other that way. And though we do those tests as well, if you have any suggestions on something you'd like to see, throw that in the comments down below. The forecast tab down here just gives you the overall return, so the portfolio balance. It shows you the income generated. This is just a quick view snapshot. It's not going to show you each individual fund. This is more like a summary table. And if you're using deposits and withdrawals, it's not going to show on here. For all of that, for the individual funds, for deposits, for withdrawals, you have to go to the Forecast Pro tab. This is a much more robust tab. It shows you the different funds, how much you have in there. You can go over here. You can see how much the portfolio total is, how much the income is being generated, and depending on your rules that you set up, and we have all sorts of rules you can set up if we want to start taking income, where we're going to redeposit income. Maybe I have SCHD paying me, but I don't want to redeposit. I don't want to drip into SCHD. I want to feed that into DGRO. So I can do that. This is set up over here where you can do that, where you redirect income and what percent you want to go where right here. So out of that income over there that was being shown, we could say, yeah, I want to redirect it all to QQQ. You turn this on to yes, and then you would put 100% on QQQ. And you want that to start on month 1 and go for 20 years. You can do all sorts of things with this to set it up how you want. I'm just giving you a quick overview of how this works. We're not doing any of that. All the income is going right back into the fund. So SCHD's income goes into SCHD. So we have that turned off. So we're not redirecting any of the income. Now we're going to compare these first three right here. After 10 years, you can see that DGRO actually beat SCHD by a good amount. Now this is based on the historical averages. If you actually do a back test where you're reinvesting the dividends, it did not beat it by quite as much, but there's a surprise at the end I want you to keep track of, because this has been very surprising to me that DGRO did that much better. And look at VIG. It outpaced SCHD by about 15,000. So DGRO did really well, and VIG did well also, but we're going to be looking at these. I want to come back to these in a minute. Now let's move from dividend growth to pure dividend yield. And there we have VYM and HDV. And this is where a lot of investors make a costly mistake. They see a higher yield and assume they're getting a better investment. But what if higher income actually resulted in less wealth? Now with those, you can look right here. You got VYM. It did about the same as SCHD. And look at HDV. It's about half of the amount. HDV has not done great based on the historical data. And again, this is just my opinion. I'm not telling you to get any of these or not get any of these. I'm just showing you what the data is presenting. Now, that is some income play, yield play, but it doesn't have the CAGR. And that's why HDV did not outpace these others. These others have those strong CAGRs where the dividend isn't just being paid, but it's growing. Now things get even more interesting when we introduce the monthly income ETFs. Your JEPI and your JEPQ. These two ETFs pay income levels that make traditional dividend investors jealous. And I know we talk about QQQI and SPY on here, which also pay a higher distribution. And then we highlight some kind of moves with like JEPI and other funds that we play with that have really high distributions. But for the regular conservative investor, more mainstream, JEPI and JEPQ are pushing the yield button a lot, and there's a trade-off hiding underneath these distributions sometimes, and depending on your age, it could be either a brilliant move or a huge mistake. Now, if we look at that, you can see that JEPI's paying 9% yield and JEPQ 10% yield. If you're just looking at yield here, there's no comparison. It's triple of SCHD. And look at DGRO, it's 1.5 points less than SCHD, but we just saw that it outpaced it because it not only had the yield, but look at that appreciation, 16%. That's why VIG, even though it's less than half of what SCHD is with the yield, that appreciation with that yield has created that strong snowball. Looking at our monthly income players here, you have JEPI and JEPQ. You can see both of those did less than DGRO. In fact, JEPI did less than SCHD. And so did JEPQ by a little bit. Not as much, but by a little bit. So just because it has a high yield doesn't mean that it's creating as much wealth. And I want to pause here and reiterate that. It doesn't mean that this is bad. You have to know why you're in what you're in. People ask me a lot on the channel, and I appreciate the questions. Keep throwing them down there. This is how we learn. This is how we build knowledge. This is how we improve our investing journey. But people ask all the time, should I buy JEPI? Should I buy QQQI? Should I get into some high growth fund? There's a lot of depending questions like, how old are you? What's your goal? What other funds do you have to balance it? There's lots of things I would want to ask before I just said, oh yeah, you should be in JEPQ or SCHD or QQQ. There's so many different things, and personal finances are personal, but you have to know what are your goals, and then what do these funds accomplish? What is the purpose of the fund? If your goal is pure income, then perhaps JEPQ is a better choice for you than SCHD or QQQ. So keep that in mind as we keep going over these different results. Just because something did a little bit better doesn't mean it's better for your portfolio, and you have to know what your goals are. If you're retired today, would you rather collect the higher income or pursue the higher growth? See, that's where I'm at. I'm at a place where I'm transitioning into the income. I still want some growth, and I keep a growth portion, but I'm not just all growth because I'm trying to get to the place where I don't sell shares and I'm just living off the income. Even when the portfolio drops in recessions and bear markets, that my income continues, and that's where I'm at. and those are my goals. And so knowing what fund fits what goals are important. So let's move on to the broad market battle. You have VOO and VTI. Now, VOO and VTI, it is basically a tie. Over 10 years, you're looking at about $31. That's not scientific here. That could have gone either way. 1 day difference, a dollar difference in one deposit, all sorts of things could have changed that. That is basically just a dead tie. So we'll call that an even on the broad market. What happened next shocked me. QQQ didn't just outperform most of these ETFs, it absolutely demolished them. After 10 years, $71,000. That is because in this 10-year period, we have been in a massive tech boom. The bull market for QQQ has been super strong. Then you have funds like SCHD that have been lagging over the last 3 or 4 years. And so this is where the various time frames can really make a difference. So I want you to see that, but also know that during this period, there were some major drawdowns on this. If we did a pure back test, you would see the fluctuation of QQQ versus some of these other funds. As we rank these, you can see just pure growth. QQQ blew it away. What I want to do now, so hold on, don't leave yet, is we're going to change this from the pure historical, because we want to see what would it be like through various cycles. Even QQQ, if you go back more than 10 years, the average starts dropping because it hasn't been in a bull run for this entire time. It has a much longer history than something like JEPI or JEPQ. What we're going to do now is we're going to go to the categories. We're going to do this very quickly. We're just going to do the 50th percentile. So we're going to compare dividend growth and just dividend income and pure income and then pure growth, broad market. Just kind of those categories. We're going to see how these did that way. When we look at it that way, you can see that the dividend players actually did really well. SCHD, DGRO, VIG, VYM, because of that snowballing of the income and growing that and going through different cycles where you get the averages more evened out. Then you have HDV still pulling the rear end here. Then JEPI and JEPQ, your pure income, still did really well, and that would be something to consider. Again, do I need income now? Am I fine with my income being a little more flat than I am with SCHD, DGRO, going to give me those growth of my income? And then you can come over here and see even the broad market and QQQ forecasting isn't going to totally dominate if we go through various cycles. This is just a categorical forecasting. See how that kind of changes. Now watch what happens when we take the individual funds, because if you believe certain funds that have exposure to things like semiconductors and AI, the whole, not just tech, but super techy stuff that's really cutting edge, the future things that are taking place, not just your big companies that are still doing well, leading the way, but really concentrated, that differs on what the forecasts show over the next 10 years. So we go back here and we change this to the manual 50th percentile, and let's see what happens when we do that. Now we have our dividend growth funds doing pretty well still. As you notice, and I want you to notice this is important to note, whether you're looking at historical, categorical, or fund specific, the dividend growth funds seem to hold approximately the same returns. That's because they're much steadier, their beta is lower, they don't fluctuate as much, and that's why your outcomes are usually very similar. They don't have these huge takeoffs and they don't have these gigantic dips, but they're nice and steady, and that's why they make great anchors of supporting and hedges for a portfolio, in my opinion. Now you come over to the income players, the monthly income. Those, again, are staying pretty consistent in all three categories, but instead of generating growth, you're generating income. So if you were taking income, that could make a difference because you're not reinvesting all of that income. Again, different things to look at depending on your portfolio. And then obviously the broad market and tech QQQ still takes up the lead there because tech is still considered to be looking strong in the near future. We have a lot of things going on. What companies in tech will be strong for the next 10 years? We don't know, but we can speculate. I think most people would agree. Tell me if you agree. The next 10 years, tech is still going to dominate the market. May not be Apple, may not be Microsoft, could be. NVIDIA may go crazy or it may drop off and something else take its place. But the sector, the tech sector, I think is still going to be very strong in the market. Doesn't mean there won't be some downturns. In fact, today as I'm filming this is the third day that we've had some really big pullbacks in the semiconductor and AI sectors, and that's normal. And their pullbacks are much harder, and that's why it's hard for people to stomach. They love when it climbs 5, 6, 7% in one day, but they have a hard time stomaching it when they see it drop 9 or 10% in one day. But that's the volatility that you get for that long-term growth. And just keep that in mind. But those are the results of that. What is the most shocking to you in that? Was there anything that shocked you? Leave me a comment down below, but don't turn away yet. Here's the surprise. The SCHD and DGRO showdown. For years, investors assumed SCHD was the clear winner. The data tells a much more interesting story. If you have the year-by-year comparison, after several years, DGRO is not crushing SCHD. In fact, it's quietly beating it over and over through compounding, but that's partly because DGRO has a higher technology exposure, different sectors, and its yield versus growth. But here's the twist. Here's the interesting part. Just when I was ready to crown DGRO the winner, 2026 has been happening. SCHD has suddenly started outperforming not only DGRO, but even the broader market. SCHD just in 2026, year to date, is up about 16%. And that's the key message. No ETF wins forever. Who should own what? In my opinion, take it for what you want. Under 50, maybe like DGRO and VIG. Add in a little QQQ for some explosive growth. But again, balance it, your allocations. This is where their portfolio planner comes in great. Let's just say we're doing all 10 tickers. We're not, but if we were, if I had a portfolio, I wanted all 10 of these. I want a little mix of different exposure and dividend growth, and I want a little exposure in just dividend. I want a little exposure in income, some broad market, and then some tech. And I'm going with a conservative, just 10% across the board. Then over here, maybe an aggressive, I put a little bit more in the growth and a little less in the dividend growth. And so you can play with that and see how they compare, what market, what percentage, what allocation. And that allows you to do that. And as an investor, depending if you're under 50, if you're over 50, if you're retired, about to retire, how you allocate it's important. And this allows you to play around with those numbers and get a feel. You can look at historical data. You can look at manual data. You can look at categorical data, and it gives you these opportunities to compare things. But remember, no ETF wins forever. No company wins forever. I share this a lot. Right now, we see NVIDIA, we see Apple, we see Amazon, we see the Mag 7 just been dominating for years. But back when I was in my 20s and younger, there was companies like Sears that were in the top of the market. They didn't call it the Magnificent Seven back then. It was different names that they used to show the strong companies. Kodak and Sears, Kmart, those were big companies that you don't hear about anymore. So it's not necessarily a company's going to dominate, but sectors definitely can for a longer period. But even sectors go through cycles. So remember that as you're planning, and don't get discouraged if one of your funds is lagging for a couple years. Be in this for the long term. Investing is a long-term play. And so to me, the biggest lesson from this study wasn't that SCHD lost. And I know those SCHD haters that laugh at me and say I'm stupid to be in it. You can have your comments. Right now is your chance. SCHD lost. I'm saying it. It wasn't that DGRO won. And it wasn't even that QQQ dominated. The real lesson is that every ETF has a season. The best ETF isn't the one with the highest return. It's the one you can actually hold through the bad years without selling, because an ETF only works if you stay invested long enough to let compounding do its job. Remember that. That's today's lesson. Thank you for joining me. That's it. Don't forget to hit that like and subscribe button. Leave me some comments, and we'll see you next time on Simply Money.